and welcome to Real Estate Real Talk. I am Marilee Rowley, principal broker of Selling Salt Lake, located in South Jordan, Utah, and I'm so glad you're joining us today. We're just going to have a quick discussion about seller financing. What is it not? And why would anybody do it? Is it a good idea? Well, there are a lot of answers. Seller financing can be a great situation for a seller who wants to use their asset as an ongoing investment, and for a buyer who is looking for low or no closing costs, and who's also looking for a reduced interest rate, comparing it to what the interest rates are on the open market. So this is the way that it works. A seller advertises that they have a property for sale and that they are willing to do seller financing. And then they'll tell you what kind of down payment they're looking for, what interest rate they're offering, and what the term is. And then if the buyer has that amount of a down payment, and usually down payment requirements are pretty steep for seller financing. And that's because the seller needs the down payment for, whatever they are planning to do with it. It covers all the fees and everything associated with the transaction. So there is usually a pretty hefty down payment amount, but then the seller can offer a lower monthly interest rate than a buyer might be able to get or qualified to get on the open market. So a good example of a buyer who might really benefit from seller financing is someone who is maybe here in the States on a work visa. I ran into this situation a few weeks ago. There was a buyer here from New Zealand on a work visa for 3 or 4 years, but hadn't had a chance yet to establish any credit in the United States. So he and his family were just not eligible because you have to have 2 years of work history typically to get a mortgage in the States. So seller financing was a great opportunity because this buyer didn't have to qualify through traditional means. Now, does a buyer still have to provide documentation about their financial situation? Yes, they do. The seller can decide how much documentation they want to receive before they allow somebody to purchase their property through seller financing or not. But that could include a statement of assets, a profit and loss statement if the buyer owns their own business, for example, or it can be a credit report. It can really be anything that buyer and seller mutually decide to produce and review. So buyers still do have to qualify, but they don't have to qualify based on Fannie or Freddie guidelines or FHA or any other traditional financing guidelines. So that can make it easier for buyers as well. Now, closing costs. Traditionally, if a buyer is using a loan on the open marketplace, so through a bank or a mortgage broker or a federal program like USDA, VA, FHA, there are going to be closing costs associated with that loan. And those costs are going to pay the loan officer and the processor and the people reviewing the loan and approving the loan and the appraisal, and could be some title fees involved, title insurance fees, paper processing fees, and those closing costs collectively can add up to be thousands of dollars. Say if you're getting a loan for $500,000, then your closing costs could be 2 to 3% of that final loan balance. So that can add up quite a bit. Well, with seller financing, really there aren't any of those loan fees associated with it. There are still a few title fees, but that's almost it. So you can get by with low or no closing costs as a buyer when you're doing seller financing. Now, does the seller still have to pay some closing costs? They do. They'll still have to pay for a title insurance policy for the buyer, and they'll have to pay some title fees, but really their fees are also going to be, they're going to be similar to what they would pay if their buyer had traditional financing. They'll be similar. But it is a real benefit to a buyer because they don't have to qualify for a loan, they don't have to pay loan closing costs, and they can negotiate a smaller interest rate. So why don't more buyers do it? Well, there aren't that many sellers who can do it. So to do seller financing, there are two main ways. If you're a seller, if you own the property outright, then you can really set all the terms and you can decide how you want to go forward because it's your property that you own free and clear. Now, when you sell it to a buyer, you are giving them title to the property. And so as the seller, you basically become the bank. You're lending the money, you're collecting the money. You do have the right to foreclose if the buyer doesn't pay their bills on time. They're not making their mortgage payment on time. You do have the right to foreclose as the seller. Well, I should say you do have the right to foreclose as the bank, which is your current role if you've already closed on seller financing. So you do give title to the buyer. Now, the second way that a seller can provide seller financing is if they don't own the property free and clear, they can still sell it to you or to a buyer on seller financing, but they also have to service that underlying loan that they may still have. So say a seller owns a property that's worth $1 million and they still have a loan that's $500,000 that they have to make the monthly payment on. Well, as the buyer, your payment has to be enough to satisfy that underlying loan that the bank now, the seller bank, is now paying. And then also usually the seller wants there to be some profitability in that payment that they're making. So they want to pay their underlying mortgage payment and have a little bit more on top of that to make it worth their while to be the bank on this property. So those are the two ways. You can do it with just a basic deed on the property, which is free and clear. The seller owns it free and clear and becomes the bank to the buyer. Or you can do what's called an all-inclusive deed and trust, which means that the seller still has to pay their underlying mortgage and the buyer has to pay their mortgage to the seller. So it can be a little bit complicated. Should you seek legal advice? My answer to that question is always sure. Please. It's always a good idea to get legal advice from an attorney if you are delving into seller financing. In Utah, and it could be different in wherever you're located, but in Utah, we typically don't use attorneys to close transactions on property. We usually just use title companies here. And if you have a great title company who does a lot of seller financing, they've got a system, they've got it down, they can make sure all the I's are dotted and the T's are crossed. Still, it is always your right to seek legal advice, and you should if you feel in any way uncomfortable with the process. But seller financing can be a great solution for many different sellers and buyers, and so it's definitely something you should think about and not dismiss out of hand. It could be a great idea. Thanks for joining us today for Real Estate Real Talk. Again, I'm Marilee Rowley. This program is produced by Kat Aspel today. Thank you, Kat, and hope you all have a great day. Please follow us on all our socials. You know what they are.